Markets are upping their bets that the Fed will finally achieve its dream, crash the economy, and make Americans eat cat food. A few days ago, Bloomberg reported that yield curve inversion is now approaching its March peak, itself the worst since the 2008 crisis. This means bond traders are upping their bets that, as Bloomberg put it, the Federal Reserve will steer the U.S. economy into recession. A separate Bloomberg poll found almost two-thirds of financial analysts expect a recession this year. The actual data, of course, agrees, with jobless claims rising to fresh highs. So what is the yield curve and why is it worth watching? The yield curve is a gold standard on Wall Street to predict recessions. It is pretty simple. Just draw a graph that traces out the interest rates on government bonds by length and connect the dots. So you've got 3-month bonds, 1-year bonds, 5-year, all the way up to 30 years. What matters is the shape. A normal yield curve looks like a hill, starting at today's rates and then gradually rising. It's rising because longer bonds tie up your money for years, so investors want to get paid more. They want a higher rate. The problem is when the yield curve goes flat or even negative. This is saying that markets expect the Fed to cut rates, which Feds do when they expect a recession. If the curve is flat, for example, it's saying, yes, I need more money to tie up my cash, but I also think rates are going to come down soon, so I want to lock in today's higher rates. The scariest shape, the one that keeps the gamblers on Wall Street up all night, is an inverted yield curve. That one is not a hill, it is a ditch, starting at today's rate, and then it's all downhill. That is one of the clearest signs in finance that a recession is coming. In fact, the inverted yield curve has predicted every recession going back to at least the 1970s, and it never lies, at least not in modern terms. If the curve inverts, you get a recession. Having said, it takes time for the actual recession to come because markets are trying to predict the future, and the first data that scares the yield curve is usually a year or two before the actual recession. So where are we now? The yield curve went flat in March of 2022, right before the Fed started their very first hike. Then, a few weeks later, when the Fed actually delivered that hike, the yield curve immediately went negative. That should have been a blazing siren to the Fed. If a single nudge off nearly a decade of zero rates sent the curve negative, it means the economy was a dead man walking. That the Fed should have treaded lightly, go easy, lest they break the thing. Of course, that's not what the Fed did because they were desperate to cancel $6 trillion of inflation coming from federal spending without actually cutting the federal spending. So they ignored the curve, instead launching the most savage rate hikes in 50 years that have already canceled millions of open jobs, thousands of bankruptcies, and a fresh crop of failed banks with every quarterly earnings report. All that with the yield curve ticking away day by day, telling us we have not even seen the crash yet. Okay, we'll be watching. See you next time.